Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the live stream. So I will be opening today and Nick is coming on a bit later. So the big event for today is gonna be the FOMC minutes, okay? So FOMC minutes, but I think the most important event this week, and yeah, so we have in the comments, so we will be live all the way until FOMC meeting minutes at 2 p.m., I'm guessing, Eastern Standard Time. So this stream will be a longer one. Today we have FOMC minutes, but you have the Jackson Hole meeting from the Fed. I hope I'm pronouncing that right. Let me see where it is. This one, yeah, Fed Chair Powell speech. So for this week, the most important event is on the 22nd of August, which is Friday at, this is 4 p.m. my time. So Eastern Standard Time should be a bit later. And yeah, basically, that is going to be the most important event. Why is that going to be important? Because everyone is wondering, what is Powell thinking? So Powell is the chairman of the Fed. Will the Fed cut interest rates? So we have a rate cut priced in for September. 17th of September is going to be the Fed meeting. We have a rate cut anticipated. I think it's like an 86% chance that it's going to happen on the Fed watch tool, but it's still pretty unclear. So this Friday, everyone will be closely listening to Powell. Is he going to mention cuts? Are they ready to cut? Are they concerned about inflation? Do they maybe want to pause a little bit more? Maybe 0 rate cuts for 2025. So that is what everyone is going to be listening to. And let's get into the markets. So to get things started, I want to check out the dollar and I want to take a look at the S&P 500. And I'm also watching the comments. So I have the comment section on the side. I will be going through the comments. And if you have any questions, chart requests, psychology, risk management, strategy, I am all ears. So let me know in the comment section. Starting with the DXY. Let's see. So for the DXY, if you just zoom in on the daily chart, this is in a massive downtrend, right? Massive downtrend. Although it's pausing a little bit here on the bottom, a bit of a pause. And that is because of the recent uncertainty. So will there be cuts? Will Powell remain in the wait-and-see approach? Will there be a pause? Will there be any rate cuts in 25? What happens on the 17th of September? That is what the dollar is watching, okay? I do think the overall story is the rate cuts will come, which is bearish for the US dollar. The current interest rate is pretty restrictive, so it needs to go down. And I do believe it will go down, meaning the dollar could go down a little bit more, depending on how many cuts are priced in, okay? So, and I also think this Friday is going to be pretty tricky because, again, a rate cut is priced in for September, but if Powell mentions nothing about a cut, or if he mentions sticky inflation, or if he mentions that he's in a wait-and-see approach, I think that could be problematic for the US dollar or for the markets. And I think the dollar could actually gain some value if you don't get any dovish comments from Powell. So yeah, that is kind of what I'm paying attention to. That's just the speech. It's just the speech. The most important thing for the value of the US dollar, for the general US economy, is going to be NFP, CPI, and PPI. So before the 17th of September, we still have one NFP event, one CPI event, one PPI event. So we will get the employment data, we will get the inflation data, and then we will see what the hell is happening, right? Should they cut? Should they remain in the wait and see approach? I think the numbers will tell it the best. So I'm closely watching the numbers. Right now, I'm a bit neutral on the dollar. I'm not sure what to expect. I'm watching the rest of the data print before the 17th of September. Until that happens, I don't really have a clear bias on the US dollar. Now, when it comes to the stock market, the sell-off looks to be starting at least a little bit. So I'm closely watching the NASDAQ for buy setups. S&P is pulling back. NASDAQ is pulling back. We have been talking about this for quite a while now. I think Nick started to mention it like a week or two ago, that the Edge Finder has lost its bullish reading, that retail is very long, that institutions are going short/neutral. So the overall concern is that the stock market could be selling off a little bit, or it can even sell off a lot. Let's see the VIX. VIX is up a little bit, so volatility is going up. That means the stock market usually goes down in value. So this could be a very nice opportunity to get in on some buy setups in these areas. I'm personally focusing on the NASDAQ because I do think the NASDAQ has the most potential to go to the upside. You have the artificial intelligence that should impact the technology companies first. Microsoft laid off 5% of their workforce, which in turn improves profit margins and pushes the stock market up. NASDAQ is mostly technology companies, so it makes sense for artificial intelligence to have the biggest impact on the NASDAQ. And that is why NASDAQ, for me, seems like a very good play to go to the upside. So I would like to see a bit of a bigger pullback, like this, rejection, and then a buy setup. Or we go even lower, go up, buy setup. So that is what I'm closely watching. I want to see price go down a bit more. Let's see by how much. Let's say 4%, or let's say 5%, something like that. And we've been closely watching this, and you can clearly see the markets have been a bit overextended. A pullback needed to happen sooner or later. I mean, when the retail is calling for higher prices, when the retail is buying like crazy, when institutions are pausing a little bit, when institutions are maybe starting to even sell, when the markets have been in a huge uptrend for a really long time, then you know that something is up, and you best be a bit more patient. I also know Nick started to selling calls right here near the top, so he started collecting premium and expecting some pullbacks. So that's a great strategy where you don't have to short the NASDAQ, you don't have to short the S&P 500, but you can sell options, you can sell calls, and you can collect premium in the process. As long as the price is just stagnating, being flat, or going lower, you can make some great extra income. So many strategies you can trade. One thing about options is, for retail traders, tough to get a lot of capital to trade options. Prop firms, they don't offer options, so that is where the problems arise. Okay, so to sum things up, DXY, the dollar, I'm a bit neutral right now, but I do think rate cuts will eventually come. I'm a bit bearish. That works well with my overall euro-dollar long position, which I will cover a bit later. Stock market, finally possibly getting that pullback. We finally could be getting that pullback. Overall, I'm bullish. I don't want to buy at these prices. I want to get a bit of a discount first, get in on some better levels, and then I would be pretty happy to buy the NASDAQ. Let's check out the comments. So WTF is FOMC. FOMC meeting minutes is, I think, a document that comes out and it says exactly what the Fed discussed before the last interest rate decision. I'm going to have to check up on that, but I do think that that is what it means. FOMC is 3 orders of McChickens. Possibly. So I'll have to do some research on that. Today was a rough day for me. Okay, if you can let us know what happened, maybe we can help you. GBP/USD falls. Yeah, so for GBP/USD, for GBP/USD, we actually had inflation print, but let me tell you my opinion on the GBP/USD. So look at this number. This came out on the 20th. So today, 8 a.m. my time. Inflation rate. Actual number higher than the forecast, higher than the previous number. So if inflation is going up, usually central bank needs to raise interest rates, which means the pound should gain value. And yes, short term, it did gain some value. Okay, short term, there was a bit of a gain in value from the pound, but long term is going down. The reason why I believe the pound will lose value long term, and that's why I am in Euro GBP buy. Okay, I'm in a buy trade on Euro GBP. So it's a trade against the pound. And the reason I think the pound will go down is because of stagflation. Now, that's a complicated word. That basically means stagflation, low growth, bad employment, high inflation. It's basically the worst thing you can have before a recession. Okay, so the worst thing you can have before a full-on recession. So that is what the UK is currently dealing with. If you go to the Edge Finder, if you look at the employment data, if you look at the GDP data, it's going down. If you look at inflation data, inflation is going up. So the central bankers don't know what the hell to do. Should they raise rates? Should they cut interest rates? You can even see it in their voting system. So before every single interest rate decision, they take a vote. And the last vote they had was 50-50. They were really 50-50. There was just one guy that said he would rather have an interest rate cut, so they cut rates. But they are kind of confused. They're kind of lost. They're not sure what to do. A very tough environment. But one thing that I know from my research, stagflation means the underlying currency loses value. So the pound should, in theory, lose value. That's why the initial reaction was bullish, but after that, we kept selling off. The markets don't really like a stagflation scenario, so they keep selling the pound. That's one of the main reasons, I would say, why I'm in Euro GBP. I think the pound is going to continue losing value. I think the euro currency right now is pretty strong. I think a lot of investors and traders favor euro as a currency, so euro pound may be a good play, except the swaps. The swaps are killing me on this one. I'm not gonna lie. The swaps haven't been the prettiest thing, but you know, it's cost of business. It's part of the game. So I'm just gonna continue trailing the position if I don't get taken out. All eyes on Jerome. Yes, too late Powell. Although I like Powell. I think he's really smart. I think Trump is a bit of an idiot for teasing him online and everything like that. And I think actually there's no sense to cut rates. Maybe cut them a little bit, but you have some problems with inflation. And so far, the US economy has been doing okay, you know? So I don't see a huge reason to cut interest rates. And I believe what Powell is saying, that they are in the wait and see approach, that they still need a bit more data, and that they are being careful. So I'm in the Powell camp, although the too late Powell nickname is pretty funny. Sell gold. I'm looking to buy gold, if I'm being honest. So if I take a look at the gold, okay, I took a buy setup, which ended up being a reduced risk loss, but that was way back. So overall, I do think we are in a massive uptrend. Technical analysis seems to be really bullish for gold right here. Fundamentals. Well, fundamentals, I think currently on the Edge Finder, gold has a bullish reading. So fundamentals are bullish. Yes, I did my forecast today, and gold should still have a bullish reading. So that's good. Macroeconomics, well, you still have some uncertainty around tariffs. You have some uncertainty around the Fed. You know, Powell is stepping away. Who's going to replace Powell? Is it going to be a puppet? Is it going to be a yes man for Trump? Is it going to be someone who's just going to keep advocating to cut rates and harm the US economy? So gold could have a very bullish case. Now, for me personally, what I was really looking to see is a breakout to the upside. I really wanted to get a breakout to the upside. But right now, I wouldn't say it's a bad idea to get in at the lows of the range. If I can get in like this. So overall, I'm bullish. There are many reasons in my analysis to be bullish on gold right now. I'm just not getting the technical entry that I want to see. If I get in right now, I'll get shopped. So if I get in here, it is very likely the markets will just take me out, go back into the range. And then I take another stab. And then maybe the markets actually do go up a little bit. And then they go back and take me out. So that's the danger of trading inside of this range. Did I just remove? Whoop. I removed all of my drawings, which I didn't want to do. Let me see if I can do this. Yes. I need to lock. So always remember to lock your drawings so that you don't accidentally delete them. Anyway, gold, maybe I'll buy the bottom of the range. It's not such a crazy area. I just don't want to get chopped around. So if I do buy the bottom, I know Nick has been talking about this as well, and I like his analysis. So if I do get taken in here, then even if price continues to range around, I'll be pretty safe. I'll be pretty safe in my area. And if that area does get broken by a lot of momentum, probably we will get a big pullback on gold. That is at least what I'm thinking. What I'm definitely not looking to do is I'm not looking to sell, okay? So I'm not looking to sell this market. Hey, Marco, I'm on the same trade. Euro GBP longs going good. Well, I wouldn't say it's going so good. It's around break even. Okay, a little bit of profits. The swaps have been a bit tricky. But, you know, it's a trade idea. I think the probabilities are behind it. I told you my stagflation analysis for the pound. I think buying the euro, selling the pound right now is a very, very smart thing to do. That's why I'm putting money on it. What do you trade? Okay, that's for someone else. How could the speech on Friday affect other markets such as the Nikkei? Well, to be honest, I haven't done my research on that. I'm not sure how speech from Powell could affect the Nikkei. Not 100% sure. I do know from just general analysis that if Powell goes back to wait and see mode, dollar could gain value and the stock market could possibly sell off a little bit. And if Powell mentions a rate cut in September, dollar goes down, stock market should definitely like it. Okay, so the stock market should definitely like it because that would essentially confirm a rate cut in September and could signal future rate cuts later down the line. So it's not really only about the September meeting. It's about 2026. Will there be cuts? Will there be more cuts? How many cuts? 1, 2, 3, 4, 5. How big will the cuts be? So even if they cut in September, but then they say, we made a cut, but we're going to be a bit hawkish. We're concerned about inflation. We don't want to cut too much. The markets will not like that a lot. The dollar could gain value and the stock market could lose some value. But as far as the Nikkei goes, I'm not sure. I'm not your guy. I'm not sure what would the effect be. Which EMAs do you use? I only use the 20. Okay, so I only use the 20 EMA. And let me tell you, the reason why I use it is to see when the market is overextended. So if the market is very far away from the 20 EMA, I may not be as happy to buy because a pullback is imminent. So at this point, not the greatest time to buy the Nasdaq. Probably you'll get a pullback at this point, overextended. You see the distance from the 20 MA, so the 20 MA is a good gauge of if you want to buy or sell things. Is the market overextended, or are you getting in at a fair price? Are you getting in at a good level? What are your thoughts on GU? Well, for GBP/USD, I'm bearish GBP. So I'm bearish GBP, but in order to play the bearish GBP move, I would much rather buy Euro GBP than sell GBP/USD. Okay. The reason is, on the Euro, I have a clear bullish bias right now. I think the European economy is doing pretty well. They're getting some steady data. Okay. So I think Euro GBP is good to buy, but the dollar, I'm not that confident what the dollar will do. I'm a bit neutral. I'm neutral / bearish. It's all about the next three, data releases: NFP, CPI, PPI, before the 17th of September Fed meeting. So I'm closely watching those 3 data releases. Then I will have more clarity. Then I will have more confidence. Right now, I am a bit neutral on the dollar. That's why I think GBP/USD is not the best play. But so basically, I mean, GBP, I'm bearish. USD, I'm also maybe a bit bearish. If both currencies are bearish, not a good play. Okay, not the best play that you want to see. If you want to buy or sell currency pairs, one of them needs to be strong, one of them needs to be weak. There needs to be a clear contrast. Otherwise, there is no trend. Otherwise, there is no edge. Gold is gonna moon. I'm not sure. I mean, you have to get a technical breakout first. We're just stuck in this range. We can be in this range for quite a long time. And this is where traders lose most of what they gained. So this is what I personally experienced and what I personally saw from other traders. You make money in the uptrend with your strategy, which works really well in a trending condition, and then you lose all of your profits in the range because you keep trying to buy. You just keep trying to buy and you keep getting stopped out. So that's a big problem that a lot of retail beginner traders face. Is they can make money, but they cannot keep it because they cannot distinguish between different market conditions. So they make money in trending conditions or range bound conditions, and they lose them when the conditions change. NZD/JPY. Let's take a look. Let's take a look at NZD/JPY. Actually bearish. We had an interest rate decision for RBNZ, which is the New Zealand central bank, and they had an interest rate cut, and it was a dovish cut. So usually it's not just the cut or hike you're looking at, it is the general tone that comes during the meeting. So it is the statement that comes with the cut. So sometimes a central bank will make an interest rate cut, but they will sound hawkish. They'll say, this time we cut rates, but look, inflation is going up, so the next one may not be a cut. But in this case, they had an interest rate cut for the New Zealand dollar, and they signaled possible future cuts as well. They're not that concerned about inflation. So the New Zealand dollar sold off heavily. Okay, heavy sell-off on NZD. I would say this looks like a sell setup to me, although I'm not that confident in the yen. I don't have a clear bias on the yen. I just think the New Zealand dollar right now is a bit weak. If I had to give you a bias, it would be New Zealand yen goes lower. Okay, if I had to give you a bias, but I do think there are better things to trade out there. The Riddler, I'm pretty good. How are you? You're number one. Okay, nice, cool. Hey Marco, hope your day's doing great. Wanted to know how's your ChatGPT strategy going this month, and are you planning on doing a part 2 of the video? Yeah, so that's actually been working out pretty well. Part 2 is coming soon. So for anyone that doesn't know, I did an experiment where I traded with ChatGPT for 1 month, for 30 days, and it made like 10 or 15%. Right now it's up 19% so far in the last 90 days. I tested Grok as well, so the AI from Twitter. That thing lost like 7 or 8% in 1 month, so that's not good. But ChatGPT is mostly taking winners, so it's up like 18 or 19%. And part 2 for that video is coming on my channel probably in like 15 days, maybe 2 or 3 weeks, something like that. Bond market is pretty mixed as well on the next Bank of England rate cut. Yeah, so the central bankers, they're not sure what to do. They're battling low employment, they're battling bad GDP data, but also they're battling rising inflation. And so you're having problems on one side, but you're having problems on the other side as well. That's called stagflation. And stagflation is very, very tough to handle, very tough to resolve. Also, Nick released a podcast today talking about what is stagflation, how does it impact the markets. So I definitely recommend you check it out. It is in the A1 Trading Discord, and also I'm sure there's a link somewhere out there. So definitely give that a listen if you want to learn more about stagflation. It's a very powerful concept to trade. The rule is, if there is stagflation in the economy, meaning United Kingdom, underlying currency loses value, meaning the pound loses value. Soccerflix says, I agree with you on Powell. Powell is a great guy. Powell is a great guy, very smart guy. Trump is a bit crazy, and I feel bad for Powell. Aussie USD, okay. Aussie USD. Well, for the Aussie USD, I'm a bit neutral, if I'm being honest with you. So on the USD, I'm neutral. On the Aussie, I'm neutral as well. Technical analysis seems flat for me. I personally would not touch this chart right here. I don't think it has a lot of edge. Let me quickly check on the edge finder. I'm sorry I cannot bring the edge finder on the screen. I'm going to have to find a fix for that. Probably going to have to open my trading view in my browser. So let me see. Aussie USD. Neutral. Yeah, getting a neutral reading. So neutral fundamentals, neutral technicals. I'm neutral, and I think there's better things to trade out there. A triangle on gold right now. Lower trend line, no time to break. Well, triangle or no triangle, I'm looking at flat support and resistance more than I'm looking at triangles. So I'm looking at this level of resistance, and I'm looking to potentially buy the level of support. So I know you can like have a triangle with trend lines. Okay, this should be a white trend line, but this is your triangle right there. I just don't really see a lot of value behind drawing this triangle. So I would rather wait for a breakout of this level to get in on a nice long setup, or a break lower, and then that would basically delete my whole bullish idea. And I'm considering maybe getting in on a small buy setup at this level of support. Okay, possibly doing that, but I would much rather get a breakout and get a nice entry here on the top. That would confirm the uptrend, would confirm to look for buy setups. NASDAQ, is AI a bubble? For sure, it's going to be a bubble. Is it the bubble right now? Sure. The question is, when is the bubble going to pop? Okay. And I'm going to be in it for the ride. Until the bubble pops, I'll be buying the NASDAQ like crazy. So I don't know when it will pop. It'll be probably the same as the .com bubble. But until it pops, you're going to get a massive move. Massive move. And you just go long, have a stop loss, and extract as much percentage from the markets as you can. That's about it. I've ran out of time, so I will be live streaming tomorrow as well. Thank you guys very much for watching. If you want to ask me more questions, catch me tomorrow on the live stream. And yeah, that's about it. Good luck in the markets. Watch for FOMC today, but especially watch for the speech on Friday. See you guys.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
Oh, Chris, I think you're muted.
Let's try it now.
Oh, yep, we hear you now.
I switched. I've got a lavalier microphone, so it's always on my shirt. It's been a minute since I've been in a live session with you guys.
Oh yeah, we're glad you're here.
Can I get a screen share up and running there, Chandler? There, perfect. All right. Well, I was going to say, hey, nice to see everybody. Nice to be back. Just jumping in for a little live sesh, and hopefully, Pulver alerts are still going well and still grinding the markets as usual. This is a pretty interesting day. The markets start off with a pretty aggressive dump. I have been actively selling calls these last couple of weeks. I was pretty much not a believer that the market's going to keep sustaining the trajectory that we've seen. So a couple things on the technical side. Once we had the kind of disrupted July 31st to August 1st, okay, and I talked about this in the Pulver Alerts, like weekly updates and the videos I've been sending through the Discord. The low was established here. We had a higher low. We had a higher low. And it was almost as if yesterday, with the time in the market crossing over, and then Monday was finally like bears received permission. So it's almost like the bears got permission to say, okay, we've rounded out the top a little bit. We're back down below the July 31st high. There's now room for the market to potentially continue lower. I think it's going to continue lower. Okay, I really do. I mean, and to what degree? Maybe a 3% correction, maybe a 5% correction. I'm going back to just like tried and true, easy to trust technicals that I've seen work over and over again. It takes a lot for the market to get overbought. It takes a lot for the market to get oversold. But we see overbought conditions right here, and that means overbought with divergence. So what does this look like? Well, do we go down for a flush, down for a flush? I mean, is it going to make another all-time high? I don't know. I mean, we have FOMC minutes today. We have Jackson Hole on Thursday, Friday. Powell's going to say stuff. Maybe the market likes it. Maybe they don't. It just depends on how explicit he wants to be on if the Fed is going to cut rates. Or are they only going to cut once? Are they going to cut rates once? It's like, how inflation focused is the Fed going to stay? I do know this. If they don't cut rates in September, Donald Trump is possibly going to kill Jerome Powell. No, he'll just go crazy. It'll be super vocal. It's unlikely going to happen. The Fed is probably going to cut rates, and it's just going to be to pacify the markets, right? It's priced in 80+%. This is rate cut probability for September, an 85% chance. We rarely see this wrong when it's that high of a probability. What is kind of crazy is 84% chance of cutting in September, and then another cut is still on the higher probability for October, and then a pause through December at this time. But and again, does this all get expressed this week in FOMC minutes with the statements today, or does it express with Powell's speech on Friday during the Jackson Hole Symposium? I don't know. Okay, so we're about to find out. But I think from a correction standpoint, I mean, the SPY minimum pullback, in my opinion, is, look at the correction here. To me, if you go into like the 5-minute chart based on today's price action, if you've got sellers out there, if you trade futures, right? If the market is like progress making to the downside, pull back, pull back, pull back. If this is like a slow, steady, like orderly retracement, and it sells off again, right? And then an orderly retracement, then sells off again. Like, this isn't a bad thing. If the correction looks like this, where it's just like We're down, we drift back, we're down, we drift back, we're down, we drift. That's good, right? What you don't want to see is like the market just goes into pure free fall. Now there's a lot of uncertainty. Then the VIX goes crazy. So a little orderly retreat is not that big of a deal. And from the technical levels, I've just got some moving averages. Here is a 50-period moving average on a daily chart. I think we find it. We have previous all-time highs. I think we find it. So between like the 50-day and the previous all-time highs, that's like a 3 to 5% correction. That's around 3.5% from the previous all-time highs, which are just a couple days ago, down to the previous all-time highs. That's about a 5% correction. If it gets a little bit more than that, I'd say 3, 5, maybe into like that 8 to 10. I don't see the market dipping too much lower than 10%. The NASDAQ could be a bit more volatile, but probably too much lower than double digits. And here's an easy way to look at to see if the bottom could be in. Let's say that we hit the 50-day and we close above it. Okay, that's not a bad spot to get long. If we hit the 100 period and we close below it and get above it, that's not a bad spot to get long. So if you get a price to close below it and then close above it, you can probably go right back to the highs. If we close below it, close above it, you can probably go right back to the highs. If we close below the 200, briefly, maybe we check this US-China trade agreement gap right here, right? And we close back above it. That is a good spot to get long. I've seen some interesting forecasts get changed. You know, everyone's talking about 7,000 S&P and 700 SPY this year. I mean, it's been a pretty resilient market. And does anyone know what the average return is every single year in the S&P? Because it's not 20%. You know, we've been made to be complacent thinking that the market just always goes up and it's going to be up 15, 20% a year. It's not. You know, the average return per year is about 8%. And we've gone down 20+% peak to trough. We've rallied 25, 30%. And the market is up year to date about 9 or 10%. Okay. So if we don't do anything for the rest of the year, that's actually within the total norm of what this market is capable of doing. Now, obviously the market can go higher and obviously the market can sell off more. But I still think that if you look at Trump administration, it's pro-growth, it's heavy deregulation, it's all about gains. This was not the mission back in February and March. The mission was Doge, cut spending, drain the swamp, austerity, and that was something that almost broke the bond market and nearly broke for a second the global economy. Like we had like truly systemic risk in April that was pivoted hard. Like probably one of the biggest like about faces or like the biggest changes I've seen from an administration's agenda, from going from we're going to cut costs, we're going to cut spending, we're going to tariff the world. And all of a sudden it's like, well, now we want to trade more with the world and we want pro-growth and we're all AI and we're going to be the leaders and blah, 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 best thing ever. Really, really aggressive shift. So the market's running with this. And that's why I think that the price action you saw back during COVID, which was a crazy crash for 30+%, and then a major pivot when the markets were throwing, you know, trillions of dollars at it. That money is still in the system. I do wonder if money is going to be, you know, rotating out of Mag 7 into other sectors. Okay. The reason that we're also down is look at every stock or I'll say every stock. Look, Mags represents the Mag 7. We all know what that is. Apple, Amazon, Microsoft, Meta, you know, AVGO's in there somewhere. It's like, I think number 8 in the world, but your biggest stocks in the world, right? Google, Microsoft, whatever, you know, Mag 7, household names. This represents like 40% of the market cap in the S&P. So if there's like a little take profit, if there's like, you know what, Mag 7 recovered this whole year, I'm up a ton, I'm gonna reduce my concentration risk in Mag 7. That little rotation out and getting the Mag 7 to roll over a little bit is going to drag the whole market down with it. Like it or not, if NVIDIA sells off like it has been for these last couple of days, look, NVIDIA has earnings next week. Okay. I think, and it's sad to say this, but NVIDIA earnings are probably the most important thing in the markets right now, because what happens to their earnings, whether it's good or bad, could also be the difference between this market staying back up to all-time highs or giving back another 1, 2, 3, 4, 5%. Because what comes with NVIDIA as literally number one market cap company in the world at $4.23 trillion, which was $4.4 trillion not that long ago. I mean, this is the largest company in the world. And if we are down like 10%, down 15%, you're going to have leveraged ETFs that are down double that, triple that. You're going to have a market cap that goes from $4.4 trillion down to $4 trillion, maybe less than $4 trillion. That's a lot of market cap that gets wiped out. Okay. So it's crazy that your largest company in the world is trading with such high swings in volatility. So this is an easy thing to look at for pretty much any stock that's in the Mag 7, any stock that's been running in the tech space for a while. Take a low from the April low. So this April 7 low, start your Fibonacci from that low. Go all the way up to this recent all-time high. Okay. And this is just NVIDIA, but do this to NVIDIA and Meta, and you can do this to AVGO. You can do this to whatever. Well, all the stocks that are just ripped, right? Palantir, do it to Palantir. Do it on Carvana, do it on HIMS. All these stocks have been high flying since April. I just expect the market to pull back, and it's totally fine. You can do it on the Dow. You can do it on the Russell. You can do it on the Qs. Take the low, take the high. I think these are realistic pullback levels. We pull back to a 23% retracement. I think the market goes back to highs. We pull back to a 30%, the market goes back to highs. We pull back 38 to 50%. It's a little bit iffier in here because it's a deeper pullback, but the market still probably finds a way to grind back up to all-time highs. Okay. If you put your future cap on and think, let's say we're going to think, 3 years from now, 5 years from now, 10 years from now, do you think the market's higher than 6,500? Do you think the market's higher than 6,400? Because I do. So all this is noise. All this is noise. Pullbacks are fine, right? Index pullbacks are fine. Index pullbacks are welcome. Index pullbacks of these last 2, 3, 4 weeks are needed. They need to happen. So a SPY pullback, drag your low from high or low to high fib. Take your fib right here, low to high. Okay. So I just want you to see how this aligns with some of my other charts. So we have the 50 period, the previous all-time highs, the 100 period, the 144, the 200. These are all moving averages. Okay. Take those and align them with, we have a 100 period moving average right around these all-time highs and a 23% fib retracement. Okay. If price is going to offer a pullback and not be like a 21 period, 21 period, 21 period, 21 period, and that's all we do, then you're going to hear me talk about bubble stuff, right? If we just keep going higher, 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 then once that structure breaks and it rolls over, we're coming back a lot further. But the markets can stay up like that for a while. So I think if we pull back now, it's better. Pull back now first, right? Maybe it's a little bit of a wedge pattern. Fine. Give us something to trade. Give us some dips to buy. All right. So that's where I'm at. Take your low, take your high. Look at the SPY. Look at the QQQ. Look at your indexes. Same thing here. There's your low. There's your high. Take your low. Take your high. Let me grab the fib here. So low to high. Right there. Okay, do we roll over to the 23%? That's the previous all-time high in the Qs. What's that correction on the NASDAQ? Probably 5-6% maybe. That is a almost 5% correction to the 50-day. This is a 7% correction back to the previous all-time highs. Okay, bring it on. All right, so that's where I'm at. Take a look at all your Mag 7s, all your high-flying tech stocks, your S&P, your NASDAQ. You can do the same thing on the Dow. Okay, drag a low, drag a high. Markets pull back, find some dynamic support in these pullback zones. Look at your Russell. Okay. I actually like the Russell quite a bit, right? I like the Russell for pullbacks and then buy the dips. I think Russell still has an opportunity for the catch-up trade, especially if the Fed is going to be cutting rates. If the Fed cuts rates, in September, in October, and in December, I think the Russell, as a small cap that has been underperforming, has the potential to catch up a lot faster. And all it means is if we see the S&P and NASDAQ resiliently going up, maybe it's going up slowly, I can see the Russell going up faster. Okay. And if you don't like the Russell because it's too small cap or it's too many companies, the Russell that are not making money, then you can do the S&P small cap as well. Okay. So if you go S&P small cap, you can trade. What's the one I'm looking for here? That's not it. I know there's like SP. What am I looking for? SP mid cap. Why am I? It's an ETF. I can't think of the ETF. Small cap ETF. This is interesting. So you've got S&P 600 small cap ETF. That's SPSM. You've got growth and value, and I just see what these are. So SPSM. I swear there's another one in here. And you have a bunch of like ETF custodians that will throw this out as well. But I wouldn't necessarily have to choose growth or value. I would just choose the general small cap. So SPSM. It's funny how this one looks a lot like the Russell, isn't it? Your S&P small cap. I mean, 600 companies is a lot different than 2,000. There's just too many companies still in the Russell that aren't making money. So taking like the S&P small cap, I think would be an interesting play, because to get to the upside here, number one, the ETF is only $44. And if we go up to these highs, that's a 12% rip. I mean, honestly, gosh, I kind of like that trade a lot, actually. So if I buy shares at 44, I could buy anywhere between 100 to 200 shares. If I put 4K and I make $400, but 8K and I make $800, it's not a bad trade. It's a little capital to tie up. I'm going to think about that. I might actually post that trade. But to me, this is like, I'm trading the Russell, I'm trading IWM. I get better premiums for that one versus the SPSM. But as far as like buying and holding, I think this has a good catch-up potential. Okay, all right, let's do some more. Let's do dollar index, gold, silver. Dollar is trading at 98.16. I just posted this video yesterday. If you got a chance to take a look at it for the pulver alerts, I'm looking for higher lows, right? And it doesn't mean that I'm long right now at the dollar. I'm looking to see one of two things. Either one is, if I'm long the dollar, I've got a pretty tight stop loss, either right below this higher low or back down to the low. The better trade, in my opinion, is don't buy the dollar right now. Just wait and see if the dollar can catch a bid, and then look to sell the dollar at a better price. I like to sell the dollar back down to these lows. I think that's a much better reward to risk scenario, right? Profit here, risk here. So I don't really want to do much on the dollar outside of stop selling the dollar. Doesn't mean I want to buy it. Just means I'm going to let price play out how I think it needs to, which is a huge trend and maybe some sideways price action, right? So huge trend, maybe sideways price action. I want to get a resistance level to sell, and then I'll take it back down to the lows as my target one. If it breaks and goes below that, I think we can get to 95 in the DXY. I think in a crazy bear market on the dollar, we can go down to 90. And that would make, I mean, that'd be pretty wild in the currency market, the dollar get that weak. But I could see it happening. Okay. All right. So that's dollar index. Oil at 62, a little stickier, 65 handle. I've got some trades in on pulver alerts that as long as oil stays above $50, I'm going to make money there. Natural gas is down to some fresh lows. This is an incredibly frustrating diagonal spread that I have running for options. My break even's like $13, so I'm not like upside down a bunch, but it's frustrating to see this thing literally dropping back down to fresh lows. We are trading 51% off of these recent highs from April. Really frustrating. So all I'm doing is I'm just selling more calls, and I'm just lowering my cost basis. I'm trying to get this thing called away for income. Gold, 33.45. I'm selling puts. So I've got two positions. I'm either selling puts on GLD, or I'm waiting for a dip into my moving averages to trade some gold futures. Right now, gold futures doesn't offer me the type of trade that I want. Although I could look at it. If we had 3,100 futures, let me see what this looks like. I'll price this out. It's probably high reward to low risk though. So gold futures, if I went out, let's say to, I don't know, end of the year, maybe January, let's see. And I looked at the mark around 3,100. If I buy 31, okay, I buy 31, and then I sell, and then I sell, and then I want to spread this out. So what's my income? I make $120. This isn't a bad trade. I don't mind this trade. I can make $1,100 if I get the profit trap. Could I maybe tweak this a little bit? $50 in income. Now I'll go a little bit wider. So the most I can lose is 880. Pretty high probability. I think gold stays relatively resilient. I think I'm going to take this trade. So I'm going to do a bear put spread, potentially a profit trap, 3,100 to 3,090. Price would have to come all the way back down here. So if price goes up, I'm going to make $120. If price goes down, I could potentially have a $1,000 profit trap. I'm not going to take assignment. I'm still risking $880, but I think the probability of this profit is pretty high. So I don't mind this trade. I kind of want to take this trade at a slightly higher premium. So $1 credit, that's garbage now. What happened to that credit? Let's go Let me go $1.50. That would give me about $150 in income. I'm still risking the same $8.50, but I've got a profit trap of over $1,000. I'm going to take this trade. This is going to be for my futures trades. So the nice thing about futures is they're very capital efficient. This only cost me $322 of buying power, and it's also defined risk. So if gold goes to the moon, I'll make some income. If gold falls, I've got a profit trap. There's a nice probability of profit in this trade to start out. I don't intend to take any ownership of this. Yeah, it's not too bad. So let me go one more strike and see. Yeah, that's a $500 jump in risk. So I'm going to take less than that, risk $880, and get this trade in. So I'm going to go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's see here, 11, 12, 13, 14, 15, 16. Yeah, I like this trade. Okay, I'm going to get in this trade. Now, it's going to be a pending order at $1.50 because I want to see if I get a little bit more of a pullback on gold to fill this trade up at $1.50 and set this up. So this would be a gold futures trade. Put this in for everyone. This would be a pending order. I'll post this in Pulver Alerts as well. Pending.
What's up, Chris?
What's up, Nick?
How you doing, man?
Good, man. Long time no see.
I know. You've been busy. I've been busy, and here we are ahead of the Fed. So it's
I'm sorry that I'm not here every single day, but yeah, the schedule's changed quite a bit. So it's nice to be back though. And I know the Fed's coming up at 2 p.m. And what do you think? What do you think? We got some drama today on the Fed?
We'll see. I do think actually on Friday that there is definitely some skew, I think, to downside risk.
For sure.
I think that there's just such a complacency with like, oh, the bond market thinks Powell's just going to pivot, be dovish, and call for rate cuts. That seems like what the Fed Watch tool has on the radar.
Mm-hmm.
But when you actually kind of like look at things from a bird's eye view, we haven't really gotten that signal from Powell. Powell seems pretty stubborn on the inflation side of it. Yes, there's some data that suggests, labor stuff seems to be calming. And I was listening to your thoughts a little bit. I do think that the markets, in my opinion, are just a little too stretched for the potential risks. Like it's almost like the market's kind of just ignoring a whole lot.
Yes.
I heard you mention too, you've got NVIDIA earnings around the corner. It's almost like the market's just so, kind of built up on that momentum of good earnings and things like that. But there are like some serious risks to the market that, we've seen. There was that one time where we were on I think it was December, where you had just a very, very hawkish leaning Powell, and it surprised markets big time. We saw big slides and a lot of things while we were on camera. I think the NASDAQ dropped like 4%. It was crazy.
Was that December last year?
That was December. Yeah, that was December.
Yep.
And you have those potentials. So to me, I look at the meeting minutes today might have something for us. There's a possibility there. But the bigger possible catalyst is Jackson Hole is historically a time where Fed officials, they make big moves, right? We got the signaling of rate cuts last year at Jackson Hole. So there is that possibility that maybe the crowd shocker could be, either a very hawkish cut or maybe possibly no cut at all until they feel ready, right? The Fed Watch tool went from 99% to 80% or 83%.
Yeah.
Like that.
So that would essentially be Jerome Powell might as well just have his middle finger up during a press conference if that's what he's going to do. That would be like the biggest like clap back to Donald Trump, where like, you can say all you want, dude, but I'm the Fed chair and this is what we're going to do. Like the market would absolutely hate it. It would be chaotic, and I truly don't think that the Fed wants that.
Yeah.
But it's hard. It's hard to just be like, well, is he just bowing to Trump's pressure? But what I read is something interesting, like even the talk of this like shadow Fed and somebody obviously replacing Jerome Powell when he's done next year, if he sticks out his whole term, is that nobody's necessarily coming in to just do straight up dovishness. Like if a Fed chair comes in as like cut by 50, like that's not going to be good either, because what we continue to do is we're cutting the short end of the curve, not the long end. So the reality is like borrowing rates might not change, man. Like if we're watching the 10-year yield, borrowing yields might not change. And the market's not going to like that either. It's just a weird place to be.
Well, and when the Fed cut You broke that down perfectly. The Fed controls the short end of the borrowing rate. So the Fed can cut their interest rates. And that's what, Trump and co, they want. They're like, oh, cut the rates, cut the rates. But the long term, long duration stuff, which is mortgage rates, which is, long term investing that a lot of businesses do, is long dated debt, real estate, all sorts of things like that. That's pretty much controlled by the market. It's controlled by, the bond market. And so just because the short end gets changed does not mean the long term has to cooperate. In fact, if we look at last year around September, the bond market kind of basically said, hey, that was too much too soon. And we don't actually, we see like potential inflation risks, and keeping rates steady for longer might be the right call. And the bond market was right. The bond market pretty much called that. They said, last year when we started to see rate cuts, the bond market very quickly predicted that we're actually going to hold rates now. Like, we need to just not really cut anymore. And it's tricky because I do think that, you have, when you look at the NASDAQ, when you look at S&P 500, when you look at the Dow Jones, they've had just such a remarkable, as you called it earlier, like the turnaround was just so sharp, right? You had the, tariff trade blocking off the rest of the world turned into super growth oriented, all focused on, not disrupting things. And we're going to give plenty of pauses away to other nations that are cooperating. And it really shifted. So I don't know. I think I went into this year, Chris, I was really long gold. And that ended up being one of the better plays that I had this year. I was really long gold. And then I bought stocks in April, I bought them in March and April and June. So I didn't play the bottom perfectly, but I felt like that was the right call. And now I do not feel so comfortable buying stocks. Personally, I'm more interested in looking for gold breakouts, looking for pullbacks in gold, and just kind of keeping some cash on hand. I mean, actually, on a personal note, I just filed for a withdrawal from my account because I'm like, I just don't see a lot of attractive stock opportunities right there. I'm doing a lot with options. I'm interested in gold, but I've got a mortgage. So I'm like, you know what? If I don't have anything to put this in or a thing that I really like, I'm just going to throw it at the mortgage and pay that down a little bit. So just things to think about is, opportunity cost of chasing markets that in my opinion are expensive. Sure, they can get more expensive, but that's my perspective. What do you think?
Yeah. I'm sitting right around that same 50% that I've been monitoring for the last, 3-4 months. It's like, I've got dry powder. I'm ready to deploy some capital. I think for me, what I'm going to do is any type of correction that we see, it's not just assume the dip is there. It's like, I'm going to play with like a wide 10, 15, 20% buffer. The way that I would love to see it play out would be some type of volatility spike above 20 again. And the reason I say that is because 2022, for example, the VIX was like in a range between about 25 and 35. And we had a pretty solid bear market through 2022. So here's, sorry, my chart's a little bit messy here, but 2022, when we had a 9-month downtrend, this is what the volatility index looked like. We were down to about 18, 19, and then we'd flash up to about 40, down to about 20, up to about 35 or 40, down to 20, up to 35, 40. So we didn't have the outlier 50 VIX or 60 VIX. But what we did have is, if we're about to see like the market's going to have to get a dose of deleveraging, then, but I don't know why would we deleverage when the Fed is like going to start cutting rates? I get we need to deleverage because we're over our skis and this like AI hype is, holy crap, we don't have the energy to actually make all this AI stuff that we want to spend on. It's like, but I think that's almost too forward thinking to have the market not love the optimism right now. I think the market still loves the optimism. I just think that August is always like an interesting month because it's a lower liquidity time. It's usually a summer lull. Most of Europe's on vacation. A lot of people in the US are getting those last minute vacations in, and you're back to the trading desk really in full time, like September onwards. Kids are back to school. It's time to grind. You got tax loss harvests in September. So there's shenanigans, right? It's like this combination of Jackson Hole this week and NVIDIA earnings next week. It's just a perfect time to like rattle the cage. It's a perfect time to just shake up the markets, shake out some of the loose hands that are hoping that the market just go nothing but up. I'm eager to buy some dips, but like I said, I'm probably going to participate in ways like this. If the market pulls back in any meaningful way, like I'd say 5 or 10%, what I'm probably doing is setting up strategies that allow me to either one, build like a profit trap here, and then sell lots of puts down here. I essentially think that I'd be pretty confident if I'm going out to like December, January next year, that as long as I can sell puts at premiums that are keeping us away from the April lows, I think those are pretty high probability trades. So for income for income for me, if I can beef up another, let's say 3 to 5% gains on just selling puts all the way down here towards April lows on the SPY and the Qs, and even the Dow is not offering the same premium, but it's still better. I mean, since UNH, United Healthcare, got its crap together, and all of a sudden Warren Buffett's buying it, all of a sudden everyone's interested in that. That's a huge weight in the Dow.
Right.
So the DIA has been up to all-time highs, while the S&P has rolled over a little bit. The Russell, I still think, has that catch-up trade potential because the Fed will be cutting. And that's just an optimism. I mean, like I said, the S&P is 500 of the biggest companies in the world. NASDAQ is just like the top 100 tech companies. Dow is like your blue chips, and Russell's your small caps. Unfortunately, there's just not enough companies in the small caps to make a lot of money. But as a whole, as we see with the S&P, the best companies raise the whole thing. So if you've got Russell that's performing better, you could have maybe 100 companies in the Russell that could drag the whole 2,000 up higher. And I think because it's been such an outperformance of large cap to small cap, it can flip and have like that kind of value play for the short term.
There's a couple things like that, Chris. Like the recency bias would tell you like, oh, you only want to be long, the mega caps, right? The Mag 7, the big guys, you want to be long those because those have been the winners. But to your point, I think that there's it's really easy to look in the rearview mirror in markets, and it's really hard to outperform looking in the rearview mirror in markets. So I've got a couple of things I wanted to show you and to the audience as well. So just to finish my thought on that, right? It's really easy to look at what has been performing really well and be like, oh, that's going to be what I want to buy because that's going to keep going. It's going to keep, and sometimes that does work. Momentum is a thing,
right?
But as a longer term theme, there's two that come to mind. What you just mentioned about smaller cap companies, I do think that they are relatively underappreciated on a bigger picture. Like I'm talking like next 5 years. I also think international stocks may be underappreciated. But another one that is kind of an interesting concept is actually the Japanese yen on that front, right? We've had this dynamic where the Japanese yen has been like, oh, this terrible trade to be long yen because we've just had the perfect, couple of years where all these banks were hiking interest rates or keeping rates high, but we may be entering into a cycle where the Bank of Japan looks to hike rates and the other banks are cutting interest rates. So the Japanese yen dynamic might change in future years.
Dude, that was literally one of my biggest points in my video this week was and this, like I don't love the Japanese yen hardly ever. Okay. Yep. But I will say that if I'm watching the dollar yen or I'm watching the Swiss yen, I think that in this cycle of where we are at right now with central banks this is the bell curve of central banks. The Bank of Japan went from negative to now positive. They're at 0.5%. Okay. Every other central bank was positive that are now cutting rates. One thing I am legitimately concerned about is that the Fed cuts in September and in October and in December and looking like they're going to continue to cut in 2026. And the Bank of Japan's like, we're not going to cut. We might raise to 1%. That would potentially be the unraveling. Like that'd be the same thing we saw like a taste of last summer with that deleveraging and that Bank of Japan carry trade. If that thing unwinds, I mean, like I said, it takes a while for me to get around a yen pair that I really like. But if the dollar yen and I don't know if we're going to get like this, obviously it's seldom going to give us like the perfect setup. But if it breaks this structure here, I'm going to use a trend line. If it breaks the structure, this is dollar yen and Swiss yen are my two that I'm watching. If it breaks this trend line, okay. I think if we break, retest, and go, I'd love an entry in here with a stop loss above. And if it's going to go to 140, that's an awesome trade. If it breaks 140, Nick, we're going to 120. And all I want to do is set a stop loss at break even and then walk away. Because as long as I'm not risking anything, I'll let the Japanese yen go thousands of pips. I don't care, but I just don't want to risk anything.
Yeah, let me show you this this chart, Chris.
Yeah,
I've got a couple charts. I'm loaded with charts today for us. So just to your point about the Japanese yen, that to me is also something I think it's really hard to time these things, but like when it goes, it will go. And if you get some sort of true risk off environment, here is the US, the UK, and Europe's projected interest rates going forward. So these are forward projections we've gotten into the Edge Finder across a couple different central banks. So when we look at the US, right, you can see the blue bar kind of over the next few quarters is expected to decline. When we take a look at the UK, they're expected, though they had a hot inflation print today, but they're trying to also cut interest rates. And then you also had, you have Europe, right? Europe wants to, they've already been cutting interest rates, but they want to keep those rates steadily moving lower. And then comes the Bank of Japan, which it's not a huge, but look at the difference in direction. They're looking to hike interest rates. And so you've lived in this world where we've all been like, oh, the Japanese yen is just a big loser. It only goes down. And it's the great carry trade that's been going for some time. But that can change. And that's where markets are tricky, is because everybody gets used to the status quo. But this dynamic, if this plays out as accordingly, you may see some strength in the yen relative to other currencies. I mean, the dynamic here where they're cutting, Bank of Japan is hiking, could cause some surprise to the upside moves in Japanese yen. I mean, Chris, a year ago, that was what caused the big slide in August. We all forget.
I know. That
is a serious force in markets that can be woken up again. And so, you kind of may have that perfect storm where a couple of these things overlap, where you have a very expensive stock market. The Bank of Japan is hiking rates. So I'm definitely cautious on that. I think those, I'm not necessarily willing to go out and short the indices heavily. I rarely am, but I do think it's worth keeping some cash on the sidelines and being defensive, especially with a market that has been pretty much straight up to the right. I've got one other chart I want to show you here really quick before I forget to do so. It's seasonality month over month for the S&P 500. So this is something we've talked about for a long time, but we do have some seasonality expected. That in September, we're expecting a little bit of softness based on the last 10-year historical average. August has been okay. Longer term, it's not been as good. It's been kind of a wash of a month. But then also take a look at this. I actually bought some calls on the VIX, Chris, a couple days ago. Okay. And part of the reason for that, I don't, and it's more of just a hedge. It's not a big position for me, but I bought some out of the money calls on the VIX with the idea being that we're entering into, as you pointed out, that back to school period where people are back on the charts and maybe doing some tax loss harvesting, et cetera. In markets, you can often get some volatility. One other thing that's interesting about this seasonality phenomenon is that I read that a lot of the share buybacks, which have a huge impact on performance of markets, share buybacks are slower during this period. So I thought that was kind of interesting. But just some food for thought. You're entering into a period where you may get some higher elevation volatility than we have had. This has been true to form here this year. Volatility has been low in May, June, and in July. So we'll see how things progress. Perhaps we do get a sharp rise in volatility. When those things happen, they can be very quick, right? So if you pull up a chart of the VIX, at any point in history, you can see we get these stretches of time where you get the low volatility range, and then all of a sudden you get these huge spikes in volatility. Last year, we had, well, in the last 1 year, really, we had two, which was pretty exceptional to get massive spikes in the VIX like this. Is that a phenomenon that's going to continue? Or are we getting these kind of short bursts in volatility? I don't know, but we'll see. I tend to think we may get something that's a little bit more real and lasting at some point, a longer term downward market, but we'll see.
Well, and I think that reality of a downward market, we're not going to see the VIX at 40, 50, 60, right? Like those have been like these just crazy, like those are essentially called Volmageddon has been like the term that's been used. So I could see, like, if we're really going to roll over, we'll probably just have elevated VIX between like 20 and 30, maybe 20 and 40. But that's just going to be like this sustained bear market where it's like it goes down, dead cat bounce, goes down, dead cat bounce. And obviously it's like 3, 4, 5 waves lower. I mean, if you want to see like an orderly bear market, learn from 2022. You want to see like a crazy buy the dip, look at COVID, look at April of this year during the tariff war. And I guess, concerns would be, we're all in on AI. It's all the hoopla. It's all the rage. But seeing some of the stocks rip from the lows in April to like up 100 and some percent. I mean, Nick, NVIDIA is the largest company in the world at $4+ trillion, and it's up 118% from the lows. Like, it's the biggest company in the world. Like, it shouldn't behave like that. You've got like Mag 7 stocks that made that type of reflexive bounce, but you've got Palantir up 185%. You've got Circle and stable coins and quantum computing. And it's like these things are just like ripping like crazy. You also have like crypto's been all over the place. Ethereum's like trying to get to all-time highs again. You have, I mean, I haven't checked Fartcoin in a while, but I'm sure it's ridiculous. You have some of the squeezes, like, I mean, companies that have no business going up, and they're up a lot, and they're chasing. It's like pumping up. IPOs are coming out in a big way. I mean, people don't realize that IPOs are actually a ripoff for the public. IPOs are available privately before they go public. And so
Yep.
the people that get paid are in way before they go public into the trading markets that we see. My favorite way to trade an IPO is don't touch it until it rallies, falls back down to the IPO price, and try to scoop it up at the trough.
And that's been
the
the
safest
theme,
way to
right? You
participate in
get
IPOs.
this, you get the initial onset of the IPO, it pops for a second, and then it just blips down for the next, so even I think Facebook even did that for like a year. It was like quite a bit where, they consistently stayed down for a while.
Yeah. Well, was it Circle? I mean, Circle Internet Group.
Yeah.
Right. This is exactly what I'm talking about. This is the one that just came to mind. So IPO here at 65, it rips up to 301. Okay. So in a matter of, I don't know, maybe 2 weeks, this thing's up 346%, but it is then given back 55% of that. So, I mean, if you really think this stock has potential, you're getting a huge discount from all the bag holders that like chase. Maybe they took some profit, maybe they didn't. I'm more interested in if this thing is going to have any type of stay power. It's maybe, okay, I'll buy it at 130. I'll buy it at 100. I'll buy it at 75. And if I want to hang on to it longer, then you can say, well, it's back down to the IPO price. And if it goes up to retest those highs, there's a good investment with hopefully sound quality, like risk management. But I've never participated in these stupid IPOs. When they're coming out left and right, they're hard to keep up with. We haven't really seen a major IPO launch since like 2022. Like SPACs were big in COVID. After that, everything dried up. No SPACs, no IPOs, super rare. And now they're like coming out like hotcakes. Like you can't get enough out there. And what's dumb is the retail crowd is chasing this stuff. And that's another thing I'm concerned with is the retail crowd is so frothy for anything to get their hands on because you're not making money on Apple anymore. You're not making money on Mag 7 anymore. So it's like, what's moving? What's popping? What's going like a rocket ship? And you're chasing this stuff. And if you take 401ks and targeted funds and you allow them to buy private equity, all they're doing is you're taking Stanford and Yale and Dow and Harvard and these like $5 to $10 billion endowment funds that are dumping private equity stakes for pennies on the dollar. They just want out. So what they're doing is it's like they're packaging up their crap. They're going to put it in the public markets, and retail traders are dumb enough to buy it, thinking it's a good opportunity because look what all these private companies have done for all these years, and it's done this return. All they do is they basically cross out the volatility. It's a huge like potential like scam and bubble that private equity. It's not what it seems, and I think that's another thing bubble under the surface with all these refis that are needed and to debt restructure in the next like 6 to 12 months. I don't know what it looks like in 12 months, man. I mean, I was thinking that the big policy shift would be if Trump and the Republicans lose power and we have a huge swing in the midterms to like go back to Democrats, go back to socialism. I mean, it's like, why can't we have a centrist person, like have a centrist policy, be fiscally responsible, be like socially liberal or progressive and be fiscally responsible. It's like, unfortunately, that two-party system we have doesn't exist. Nobody's central at all. And we're just left with like polarizing here, best policy ever, worst policy ever. And you toe the line to vote your party. I hate it. It's like, that's why I'm a centrist, but I don't know what that's the big policy shift that happens in 2026.
Yeah. And what's central also to that conversation right now is what's happening with the Fed, the challenge between the administration and whether or not they can kind of tell the Federal Reserve what they should be doing with interest rates, which the Federal Reserve is supposed to be kind of this independent group. But then you could fire back and say, well, what about if the chairman leans one political affiliation over the other? It's right. Very difficult. It's a challenging circumstance. And I think, at the end of the day, from a trading perspective, it to me, it's just always about risk to reward. And it's just when I look at the indices, when I look at the markets in general, we've really priced in kind of a perfect storm, even though there is still serious risk to multiple of the stories. We still could get the tariff uncertainty. I'm not necessarily saying I think we will, but you could get that uncertainty come running back in if something breaks down between the US and China. I mean, we've seen how quickly markets can fall on the, process breaking down, but that's just one of the possible risks. So to me, it's like, the reason you wait for dips in a simplified, overly, dumbed down way is that essentially, if there is risk already out on the table, the market can kind of like get some good news to recover that. But if the market has just good news after good news after good news, it's very hard to keep impressing a market that's made those kinds of moves. You were talking about earlier, it's really hard to get a market to be really overbought or really oversold. And I agree with that. It is hard to, when you have a market that's just gone up and up and up and up, it is really hard to get this thing to just skyrocket from here. It could happen. But to me, the easier, big move would be to the downside, would be if you got something that kind of shook this market and it's kind of perfect storm that we have. So I do like the idea of buying a bigger dip if it does occur. But I'm not really in here buying this dip here yet. I don't think that there's much to do with that.
Yeah, and to be fair too, it's like, and I really don't know what the breaking point is to get this thing to roll over to be down 5 or 10%. Yeah, I think it's needed. I think it's necessary, but like, I couldn't tell you what the catalyst is because we've literally listed 10, 15, 20 things that could potentially, but it hasn't done it yet. We've climbed the wall of worry of all these things. It's like, it hasn't done it yet. So, I mean, I'm putting on the radar, like if the Fed cuts in September and bond yields don't budge, that's probably not a good thing. If we cut in September and we're looking to cut more through 2026 and the Japanese yen decides or the Bank of Japan decides to raise rates, that is something that should be on your radar for potential unraveling of risk in these next maybe 6 to 12 months. Yeah. So, I mean, I could see some like black swanny type events, but we possibly talked about them. But that's the hard part is we never know what it is. I think at this point, like Trump's communication probably doesn't want to break the market. So he'll probably tighten up his tweets, I guess, or his Truth Social stuff. Thank you for your attention on the matter. He might tighten it up a little bit. But we're pro-growth. And I think what's interesting, this is a podcast I listened to last week, that if the market falls like during Jackson Hole and falls because Powell says something the market doesn't want to hear, Trump can come in and just place more blame on Powell and say, look, I told you he's Mr. Loser, Mr. Too Late, blah, blah, blah. And it also gives Trump more power. It also gives him more power to be right about just bullying and trolling like the Fed and just making it seem like the Fed is way less impactful than they really are. And maybe it's true. Maybe the Fed at this point, I mean, did you hear that Bessent was talking about maybe like AI related Fed decisions, or once they get it established where you just measure all these inflation things like Trueflation does, as opposed to the Fed's, textbook inflation readings and CPI and core CPI and super core CPI. It's like, these aren't real. Like this isn't the measurements of all things. This is like very specific, exclude food, exclude energy, exclude housing. That's a BS inflation print. And the reason they do that is they're suppressing inflation numbers by the data they have to release, because you have to pay that. If you own a TIPS, like which is basically an inflation protected bond, if you own a TIPS bond, it is supposed to keep up or at least match inflation. So what do you think the government's going to do? Suppress their inflation numbers so your TIPS bonds are going to be only showing like, oh, you get a 2% yield bump this year. But inflation's maybe 4, 5, 6% in reality terms. So anyway, it's just manipulated data. That's all.
That's an interesting point. And I have heard people talk about, potentially just using the bond market yield to set interest rates, just look at the 10-year yield and base it off that. But Chris, I know you mentioned, or at least to the team, I think you mentioned having a cutoff.
I do have a hard stop. I'm a few minutes behind, but I do have to run. Sorry, I couldn't stay longer. I'd love to do this some more in the near term.
All good, man. Thanks for coming on. Thanks for sharing your thoughts. Everybody who enjoyed listening to Chris, make sure to go check him out. We'll drop his YouTube channel if you guys want to go find him and follow up with him. I highly recommend it. He's got some great content he puts out over at Chris Pulver Trading on YouTube. Chris, thanks for coming on, man. I appreciate nice talking to you.
Thanks, Nick. See everybody.
See you, man. All right, guys, we'll keep going here. We've got about 25 or so minutes here before we get the meeting minutes dropping here. Market is really on edge about what's potentially coming on Friday. The Jackson Hole Symposium. What could come with that? That is the big question of the week. Jacob, I saw in the chat, Jacob mentioned he did some research on the average performance of stocks in the market and said, what is your guess on it? My guess, only from what I've read before myself, is that the average stock, like including everything, things in the S&P 500, small stocks that are like in the like the 5,000 stocks that are listed or whatever, I think it's like on par with the return of like bonds. Like, isn't it like 4% or 3% or something? It's like terrible because you have a lot of companies that go to zero. even, you have some great, phenomenal companies, and then you have stocks that just completely fall out. But I'm curious. Let us know, Jacob, in the chat, what is the average performance of all stocks? Oh, here it is. He actually put it earlier. I see it now. The average return of investing in a company is minus 18.6% per year for the last 10 years. Well, there you go. Yeah, I guess I'd be curious to see, like, if you were to do that same study over the course of like stocks that are over a certain market cap, because there's a lot of stuff that is like tiny stuff that just like pop fly and then they fall off the market and crash. I'm wondering if you had, like, let's say you did something over a certain market cap, or like some way to measure the size, just to show it's like it's a legitimate company that is profitable. Like if you did something that has positive earnings, what's the average return going forward of that? Something like that. That would be interesting. But yeah, it would definitely not be, because indices are kind of winner takes all. What the indices sort of disguise within them is that when you buy the NASDAQ or the S&P 500, you have a ton of mini pieces of stock in lots of different companies. And some of those absolutely stink and others absolutely rocket. Like there's some stocks that are in the S&P 500 that are carrying a dramatic amount of the weight, the performance of the overall index. Like, for example, NVIDIA for the last few years has been a major contributor to the overall returns of the indices. So by owning the indices, you own some NVIDIA, you also own some stocks like, I don't know if Pfizer, I think Pfizer's still in the S&P 500, but here's like Pfizer, right? Which has been a really not great stock in the last few years. So it is something to think about with the indices. What you truly get is sort of an average of a lot of big companies. It's why they're hard to beat, because when you're trying to beat the performance of the passive index, you're fighting against something that has something essentially that lets its winners run and cuts its losers short. Because what happens is when stocks perform really poorly and drop off the face of the earth, the indices automatically, periodically shuffle in new companies and kick out bad performing ones from them. That is why the strategy behind indices themselves typically is pretty good over long stretches of time, because it keeps in the winners and it kicks out the losers. Anyways, let's take a look at some charts here. I am bullish on gold and silver, but still, I know it's painstaking out there. If you're someone who also watches the daily chart, it has been rough in terms of finding trades. Things have just been trading in very tight ranges. I've been looking at silver for a possible long. If we got down into this 36.50 level, all I can do, guys, all I can do is stay patient and keep waiting for setups to come to me. I've built my trading career and strategy all around, you got to wait for the right trades to come for you. And sometimes that leads to a week or two where I don't have very many trades to take. S&P 500 was down a lot more. It recaptured some of its losses here. Same thing with the NASDAQ. It's actually captured more than 50% of its losses here back today. Nice little bounce on that one. Dow Jones is pretty much flat on the day. Russell is slightly lower. I think, reiterating what Chris was saying earlier, I do think that the indices have a very natural potential to pull back. And if we start doing some fibs, right? If we go from the swing low of April's low till the recent high, if this is the start of something bigger, this is where the risk reward, this is where I'm a little bit cautious. You start looking at this and you say, okay, we have a lot of room just to get to the 38.2% retracement level on the indices, right? Take a look at the NASDAQ. You're talking about that is a move lower of 9% further to go. That would be a pullback overall of about 12%. Very normal for the NASDAQ. That is, kind of a run-of-the-mill pullback on the NASDAQ. What about the S&P 500? How much of a pullback would be appropriate here? 38.2% is about, let's go, about 8% from current levels. From the highs, that would be a pullback of just about 10%. And again, that is a healthy pullback. You don't get 10% too often, but you usually get it like once a year. This year, we've already had a big sell-off. Obviously, we had the 20% drop following the tariff fears. And then we've just had one of the most incredible rallies in stocks that I've ever witnessed. This is on par with the COVID pandemic bounce back. And what you may remember, if you've been trading for a while or if you've done some market research, Go back to 2020 and you can see how eerily familiar this kind of was. But there's a circumstance here that I can't really justify, and that is this. Okay, so COVID, you had a huge shock to the market supply system, and then the markets rebounded sharply back higher. Interestingly, this was also under Trump. So he had the big fear, big drop off. And then, people were like, oh, we're going to get pro-growth, whatever. And we also saw the Federal Reserve cut interest rates and print a ton of money. They also continuously reiterated when inflation started to rise because of that it was just going to be transitory. And so the market just cheered and went and went and went. So are we going to see something similar? It's kind of a similar story, but there's something I can't fully get behind with this time around, which is this time around, we don't have rock bottom levels of inflation. We already kind of still have inflation in our system. And the Fed is also probably a little shell-shocked from cutting interest rates like crazy in the COVID pandemic, only to be met with a multi-year run of inflation. I don't think that the Fed has the same willingness now to cut interest rates so dramatically, but also to reassure us that inflation is going to be transitory. I don't think you're going to get the exact same story twice. Maybe I'm wrong. Maybe we do get the same story twice. Maybe we run into another, massive melt up that keeps going. Look, I'm bigger term, still very bullish on markets. I think corporate earnings will continue to be very impressive. I think that AI truly is a real thing. I don't think it's a big bubble. I think it's really strong. But that does not mean that every single day the market is a buy, right? Markets, even in bull trends, move in waves. And right now we've just had one big leg up. So to me, a natural path of least resistance is not to short the market, because I'm not bearish. I'm not willing to say like, oh yeah, no, the market should drop from here. I don't have enough evidence to really support that. But I do have evidence to say that the risk to reward for my trading style is not very good at these levels to go long. It's a lot more attractive for me to go long, even just at 6,200, 6,100, or 5,900. Those levels start to look a lot more attractive. We have some key levels of support. We may have a little bit less frothiness or overbought status at that point. And to me, that would be a lot more attractive. What I'm definitely not going to do is I'm definitely not going to try and short this market aggressively in a bull market, because again, there's graveyards full of bears that have tried to short bull markets. It's not a very intelligent thing to do, in my personal opinion. But that does not mean that we just go long, right? So for me, like I said, the path of least resistance for indices is be patient, wait for pullbacks. And for those who are familiar with calls, my perception of the market is essentially I have the perspective of a covered call. Makes a lot of sense to me. And so I've been actually selling covered calls on a lot of stocks that I own. It's essentially a sort of bullish position where you are long stock, but you also short calls out of the money. And that's what I've done on a lot of my personal positioning is I've shorted calls against the stocks that I own, capping my upside, but collecting income, which helps hedge my downside in case we get some downward risk. So I think path of least resistance is we chop sideways or maybe move lower. But I really don't have a strong conviction to say, oh, I think markets are going to rip. Maybe you get something really dovish from Powell tomorrow. Maybe that is a catalyst that keeps making this market move higher. And if that's the case, I missed a part of it. That's fine. But if we get some downward surprise, if we get something from Powell that is more hawkish, this market to me could slide very quickly. As the market itself is really, really priced for pretty much perfection. It's priced for good news after good news, and it's gotten used to getting good news. So to me, the risk is more skewed to the downside, meaning if you were to be long, to me, the risk is higher on that side if you were to go like 1-to-1 with going long or short. So to me, that's just where I'm being careful. Let's take a look at the dollar here. Pulling up the dollar index, I'm still just painfully neutral, man. It's been, not going to lie, the last like few weeks of trading has been really, really boring. And not even in the right way. Not even like, oh, I'm just in trades and I'm just managing them. It's been like, I've just been doing options, like shorting calls and puts. That's pretty much all I've done for the most part the last few weeks, because I've just not had a lot of volatility. Now, that's been great for option selling, because if the markets don't move, you make money when you sell options. But in terms of like FX, in terms of indices, we haven't really been getting much volatility in either direction. The indices have really largely not been moved very much in the last few weeks. Same thing with gold, right? Gold is just a nightmare for range bound, traders. You might love this. If you're trading the back and forth moves in gold, then this has been great. But if you're someone who's a trend trader, this has been rough. I still am looking for breakouts on the higher time frames to sort of solidify that maybe we actually have some sustainable trend in one direction or the other. If you're a 4-hour chart trader, maybe you're looking for a move back down towards the lows, in which case, if you're looking for that, maybe a break of these structure lows could be interesting. But I generally a little bit more lean in the bullish direction when it comes to metals at this time, but I just cannot justify. I can't, I know it from a content perspective, it would make more interesting content for me to have trades, excitable talking points to share with you guys. But, on my channel, I do my best to just keep it real with you in terms of what I'm actually trading. I love trading the metals, but I can't find a trade here that makes good sense to me at this time. A pullback to 36.5, that excites me on silver. A break through these structure highs with a nice solid green body candle, then you're talking about something I can chew into. But choppy back and forth markets, I will not bring myself to trade those things if I don't have a really good setup to go with it. So again, kind of a boring commentary, I know, but that does not mean that tomorrow all this can't change, right? So we get meeting minutes in about 14 minutes. We'll see if anything changes there. Indices, like I said, I'm pretty neutral, if not slightly bearish on indices at this time in the short term. I'm not willing to short. I don't have enough conviction to short, but I would definitely lean more towards the perspective of I think indices could continue to cool off for a little bit and pull back. Let's see, what else do we have? Oil prices, I'm looking for shorts if we were to get a bounce. So if we get a move up to 66, this is an area of interest to me. If we get a move up to 65, 50, 66, this past level of support turned resistance looks really attractive to me for possible shorts in that region. Let's see, what else do we have on the top setups page? Top setups, we got oil shorts, we got dollar yen shorts. This might be interesting to look at. I saw Ball Out talking about this one here. Let's pull up dollar yen. Yeah, dollar yen to me looks like, again, painful part about this one is you're going to be paying a huge fee in terms of swaps to short this pair. And in a market that is so low volatility, I struggle with this one too. Yields dropping here, but my directional bias on dollar yen is to the downside. I think that the Bank of Japan, looking to hike rates while other central banks are looking to cut them, favors yen's strength. Big picture. Timing that, though, really tricky, and especially with a choppy. I mean, this, for example, let me show you guys what I mean by this. Swing trading dollar yen, the painful part about this is that if you were just holding a short position for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, let's just say you shorted in this candle. You held for 13 or 14 days, that swap is eating into your trading profits real quick. Even if you shorted like right here and the market is lower, you could be underwater on that trade due to the swaps. They're expensive. So to me, shorting dollar yen is a very rare trade that I'll put on, but it is not something I do very frequently just because of the high cost to holding the short position. So yeah, if you're, to be honest, I would prefer, if I thought dollar yen was going to move lower, I'd actually prefer to trade TLT or bonds. There's not a super strong correlation here, but a lot of times it is a similar story where if you think the Federal Reserve, if you think the US is going to cut interest rates and the yen is going to get super attractive, relatively speaking, maybe a way to reflect that interest would be to long TLT, which actually pays you to hold it. So it's a ETF that tracks the 20-year treasury bond. So it's a way that you could potentially actually get paid to hold the trade. And this would be, if I'm really bullish the yen, it's not perfect, but let me just do a little bit of experiment. Let's see if we can play around with this really quick. If I go correlation coefficient, I want to look at a correlation to dollar yen. And I want to pull this up and I want to apply that and I want to see if there's anything of a correlation here. I'm not sure that there is, but I just want to study it. TLT inherently is difficult because it doesn't perfectly correlate with the dollar either. Yeah, you can see actually there's very little correlation. So scratch that. But for a while, for what I must have been thinking is this longer period of time where historically there has been some periods where there's some sharp inverse correlation between UJ and TLT. So you could place a long trade here and that'd be kind of like a short position on dollar yen that would actually pay you to hold it rather than dollar yen, which costs you an arm and a leg to hold that short. So anyways, to me, another thing to think about is just still very boring, but within a low volatility environment, keeping a little bit of cash on the sidelines ready to go if you get that spike in volatility is where I'm also really interested. Just something to think about. Also, real quick, guys, I got something. We mentioned it earlier, and some of you guys might have already seen this announcement. But if you have not already seen, we dropped today a free version of the Edge Finder where traders can try out the tool and see what it's all about. Some of you guys, I use the Edge Finder all the time in my videos and live streams. If you're not yet currently using it, we'll drop the link here in the chat to where you can sign up to try out the demo version of the Edge Finder. This gives you the chance to explore the full list of features within the tool, see what they're like. There is a delay on the data, but it gives you a chance as the user to explore the features that we offer within the Edge Finder and see if it's right for you. We also do offer a 30-day full access trial that you can get information on by clicking that link and filling out that form. It is, like I said, it's available on our website now with this form. Once you fill that out, we'll send you the link and get you access to explore the Edge Finder completely free. It is a free demo that we offer, and there are some features that are several of them are delayed by a couple days, but there are also some features within the Edge Finder free version that are completely up to date and fully functioning versions that you can start using today completely free on our website. So fill out that form, take a second, and would love to give you a chance to explore it and see if it's right for you. And maybe in the future you choose to purchase and support our work, or if you don't, we still appreciate you checking it out and would love to hear some feedback on your thoughts on the tool. But like I said, link is in the chat if you want to explore the free demo version of the Edge Finder. So what else do we have here? Bitcoin trying to bounce. Actually, you got a little bit of support here looking left. Let's see if Bitcoin bounces here. You've got, again, price came down to this area, found support, come down to this area again. We'll see if this bounces. I'd like to look at the Bitcoin to gold ratio as well. Can we look at the put to call ratios? Yes, let's do that in just a second. So if I go, what was I just about to look at? Oh yeah, market sentiment, Bitcoin to gold ratio first. Just wanted to pull this up and see what risk sentiment is looking like. You can see that the Bitcoin to gold ratio, which has been trending up, seems to be sort of curling over, foiling over. So to me, that signals you might be getting a slight change in risk appetite. We've seen this thing go from kind of this upward trajectory in risk sentiment to now trading sideways. All this is doing, guys, is it's looking at the price of Bitcoin versus the price of gold, which is outperforming, which is underperforming. And typically when gold is outperforming, it's more of a risk off environment. When Bitcoin's outperforming, it's more of a risk on environment. When this chart is moving up, that's telling you that Bitcoin is outperforming gold. When this chart is moving down, it means that Bitcoin is underperforming gold. Gold is outperforming. So it can be a really useful indicator of risk sentiment in markets. So yeah, anyways, when we take a look here at Bitcoin currently, Bitcoin sitting at support, it's had a pretty big tumble. That was a good drop. It was a 9% drop, which I guess is nothing for Bitcoin. Bitcoin can have some really crazy drops and pops. Gold, however, has just been, like I said, completely dead in terms of volatility. I mean, if you're trading like the lower time frames, you've got a little bit of movement here, but it's just been one where you get a trend that starts and then it just fades back the other direction. And that can be really, really challenging to try and trade. If you trade on the 1 hour, if you trade the 15-minute, you may feel what I'm talking about personally, because it's just been so choppy. And every time it looks like it's starting to move in a direction, it fades back the other way. And up 1% today. I would love to see gold actually catch a bid. What I mean by that is if we could get some sustainable movement higher and even a breakout, like I would love to see it, just because again, it would be a market that's moving with some cleanliness, with some momentum. I'm just a bigger fan of trading that type of environment. Let's look at the put to call ratio. Jay in the chat asked for some put to call ratio action. We can definitely do so. Look at this S&P 500. Look how quick that sentiment can flip. So we had high levels of call buying going on, right? So a lot of people buying calls, which are bullish bets in the market. So the crowd sentiment was really bullish the last few days. Sure enough, market drops off a little bit yesterday. Put to call ratio jumps back up, and I bet you today it's going to go even further to the upside. As you know, you had a lot of droppage in the market here. I shouldn't say a lot. It just feels like a lot because the market's been so quiet. But you had a movement lower here the last 2 days, and it's like, oh my gosh, you finally have a little bit of movement, and then you realize that whole move on the Nasdaq is just a 4% move. It's just we've been used to just this dead zone of no movement in markets. And again, I say this because I think that there's a change in that coming. And I'm a big fan of, when it comes to positions that I have on, I don't just wait until they've moved in my favor to talk about them. I posted on my stocks channel that I went long the VIX, which is something I rarely do, but I've been adamantly pointing out on my channel that I think volatility is underpriced, that I think that you could get some sharp scares, and the market is priced for such little forward-looking volatility. And markets, in my view, are unlikely to stay very quiet like this for very much longer. Maybe I'm wrong. And if I'm wrong, guess what? The market will tell me because I'll lose money on these calls that I bought. But if I'm right, if we get a pop in the VIX between now and November, I could make a nice little payout on these VIX long calls that I've got. So, yeah. I've been sitting real nice on gold miners since May. Such a chill hold. Just Jason, do you have GDX or GDXJ, or do you have individual? Do you have like Newmont? What do you have? Here's GDXJ. Yeah, gold miners have been killing it. Look at that. GDX, and that's nice because gold itself has been kind of underperforming. So you've got GDX. Okay, nice. Jason's got GDX. I've had some great trades over time on GDX too. Trades with a lot of volatility. If you're an options trader, I love selling options on GDX when it's low. To me, it's a little bit stretched right now for longs, but hey, you know what? We'll see what happens. Very nice. Congrats. Gold itself has just been a boring nothing burger for the last few months. I've gotten a lot of requests, obviously, like, hey, Nick, what are your thoughts on gold? What are your thoughts on gold? I get that comment like actually probably 100 times a day. But there's just a point where you're like, okay, look, things not moving, move on to something that is. And there's very few things that are moving. However, all of that, ladies and gentlemen, can change could change the next 1 minute. We're about to get the meeting minutes. I'll keep an eye on what that brings, if it brings anything of interest. Just a heads up, I know people are going to ask, are you turning on the speech? There is no speech. The meeting minutes are just meeting minutes. They are notes from a privately held discussion between Federal Reserve officials. This is not a Jerome Powell on the press conference. That will be on Friday. He's got the Jackson Hole Symposium. I will be doing a live stream for that. That's going to be big stuff. We'll see if anything happens. I'll tell you what, most of the time, meeting minutes do not move the market. Every once in a while, you get something that shocks the market. That's what we're gathered here for, to see if that does anything big. Guys, in the next 1 minute, we will be getting the meeting minutes. I mentioned this earlier. If you want to try out our tools, we just dropped a free version of the Edge Finder. It is a limited version that gives you the chance to explore some of the features of the Edge Finder. If you want to try it, we got 1,000 people here. Wow, my goodness. If you're a fan of the channel, you want to try out our tools that we use here on the show all the time, all these different macro market scanners, fundamental analysis, data points, risk sentiment, institutional tracking tools, all of that stuff, you can try it out here now with our Edge Finder free demo that we just launched today. It is brand new. And I don't know, did the channel hit 500K subscribers? Can one of the producers, can you guys check for me? I think we're like really close to 500K subs. So thank you very much for the subs, for the support, and for joining me on this channel. We got 10 seconds to go. Let's see if we get any volatility here with the meeting minutes coming up in just a second. Got 3 seconds to go. 200 subs away. Okay. All right. Very nice. We're pretty close, guys. Hit the sub button if you want to help us out with that goal. Well, I guess the goal. Well, with getting to that 500,000 mark. That's crazy. Absolutely crazy. Let's see. Let's see what we get. See if there's any volatility. I'm going to keep an eye on news headlines. For the regulars that want to help out with the show, do me a favor. If you see anything come through on the meeting minutes, let us know. Share it in the comment section. Share it with the class, and I'll pull up your comment on the screen. That would be super helpful. Very, very interesting. Just to keep an eye on this. And the reason you're unlikely to get spikes is because meeting minutes upload, and then of course all the algorithms go read the notes and people digest the notes and they start trading. So it's less of like a NFP number where you just get jobs report dropped. It's more of a, we'll see in the next few minutes if people start to pick up on something that was mentioned in the meeting minutes that was changed from the prior one. Let me see. Pulling up FOMC meeting minutes. Here it is. All right. Let me see if I can make this a little bit bigger. Keep an eye on some markets here in the background too. Majority saw inflation risk outweighing employment risk. It's a little bit more hawkish to start out here. Let's see what we've got. Just see if I find anything that sticks out to me. Although swings in net exports continue to affect the data, recent indicators suggest that the growth of economic activity moderated in the first half of the year. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. So right off the bat, a little bit more pointed towards labor data looks okay. Inflation seems elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks of both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal rate. We know that. And considering the extent and timing of additional adjustments to the target rate range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning to the 2% target. Okay, let me just see if we are seeing a little bit of downside movement in the indices. Gold is just ever so slightly lower. Dollar index just slightly higher. Thank you, Othman, for sharing that. Many noted full effect of tariffs could take some time. That also sort of could be taken hawkish or dovish, right? You could argue, oh, that's going to cause inflation down the line, so we shouldn't cut rates. And then you could also say, well, it could worsen the economy, could hurt the economy in some way that we're not thinking, that could cause unemployment to spike. We should cut rates. So there's sort of risks to both sides with that. Concerns about elevated asset valuations. Yeah, the other thing that you have to guys remember, the stock market's at like all-time highs. It's pretty close. So the Fed does not feel, believe it or not, as much as they say they don't look at the stock market, the Fed totally does look at the stock market. Actually, they don't say that they don't look at it. But they wouldn't say directly, oh, the stock market's selling off, that's why we're going to cut rates. But that could be a serious reason as to why they cut rates. Some participants said it would not be feasible or appropriate to wait for complete clarity on the tariffs' effects on inflation before adjusting monetary policy. Yeah, so in the notes so far, it kind of seems a little bit hawkish. Very interesting. Dollar slightly up here, gold lower, stocks mixed. I mean, the Dow Jones taking a little bit bigger of a hit, Russell taking a bigger hit. Let's take a look at yields here. Yields were down a lot more this morning, so maybe a bounce in the 10-year. Little bit, not much though. Individual stocks. NASDAQ down 1% today. So, and you know, there are times where down 1% in the NASDAQ is absolutely nothing, but recently that's a big move. You've just had such low volatility. Why is the statement you have from the 30th of July? The meeting minutes are posted later than the actual meeting. Where can I watch the Fed minutes? Like I said, it's not a press conference. Jerome Powell's not speaking right now. It's a publication of a document that I just pulled up on the screen. So this is the Fed meeting minutes. It's not a press conference. The Fed's policy is to say nothing, circle back and repeat the nothing said, then end on a nothing was said note. There you go. Fed meetings came back hawkish, likely further down with more volatility when Powell speaks Friday. Sam, I would agree. It does seem like the Fed meeting minutes just came in just a touch more hawkish than perhaps expected. I mean, what we wanted to see here, or what we do want to see, I think, going into Friday, and this to me signals you might get more of a chance that Powell may be a little hawkish on Friday. You want to see them saying, we very much think there's a risk to employment data and inflation. But this line says a lot to me. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. So I guess the one thing you could point at, though, is that if this is 30th of July and you get, you had that abysmal jobs number that came in a couple days later, they may revise this and may come in across a little bit more dovish when we hear from Powell on Friday. But we'll see. Does hawkish mean up or down? Hawkish means that the Federal Reserve is less likely to want to cut interest rates. Dovish means they're more likely to want to cut interest rates. Dovish is generally bearish for a currency, bullish for gold, bullish for stocks. Hawkish is generally perceived as more bullish for the currency and bearish for gold and stocks. But yeah, yields here still kind of staying steady ahead of the Fed meeting. There's to me a potential that you get, or not the Fed meeting, the Jackson Hole Symposium. To me, there's the possibility that Powell will really take the stand and he'll say the Fed should be independent. The president can't tell us what to do, and we're not going to cut rates. I don't think he would say it that way, but that to me seems like you might get that surprise. A lot of people are thinking that Powell is going to pivot dovish. There also is the possibility that he signals a dovish cut in September. I'm sorry, a hawkish cut, where he says essentially a one rate cut might be appropriate as the data falls, but that they're unlikely to see 2 or 3. He may not say it in those exact words. The market obsesses over every little thing he says during these sorts of events. But that would be what people are looking for, is a hawkish cut, meaning we may cut rates, but it's probably one and done. But we'll see. Will the Fed meeting have an impact on the probability of rate cuts? So yes, very likely. That's why this week the big event is Jackson Hole. Jackson Hole is it's just a big, yearly Fed event. And I've mentioned this many times, but historically that is a time in which the chairman can kind of like leak out or show a little bit more of what their plans are on stuff. And so it's very heavily anticipated. You may get a Powell that comes in swinging on the hawkish side saying, you know, we're still struggling with inflation. There's too much risk to the inflation side. Or you might get a more lenient, like, hey, you know, the jobs data is also looking soft. Maybe we should cut rates. Or you might get kind of the somewhere in between. We see a little bit of risk to both sides. Maybe a cut is appropriate, but we don't see too much need to do so. So that would be more of a hawkish cut. So that's what we're looking for on Friday. Everybody who's here, we got 1,300 people. On Friday, we're going to be streaming that event. It's probably the most important event that we've had in quite some time. It is Jerome Powell's last time doing the Jackson Hole Symposium. Is there the small tail risk that Powell makes his stand against Trump and says, you know, essentially the Fed should be independent and presidents shouldn't be able to kind of like bully Fed officials? Is that something he would try to state, or would he kind of more just say, hey, look, data looks a little bit mixed. Maybe we should cut rates. That's why it's up in the air. That's why the markets are going to be really volatile, in my opinion, on Friday. I think you could get some very surprising moves on Friday. Let's take a look at some sentiment here in the room. Crowd sentiment has been kind of mixed. We are going to get the latest AAII investor sentiment survey. That will come out tomorrow. So keep an eye on that. If you have the Edge Finder put to call ratio, I'm really curious to see what it looks like after the bell here today, what crowd sentiment is looking like for that. We also, if we take a look at institutional positioning, I find this to be really interesting, guys. You have recently seen selling in the dollar, right? Look at the yellow line. The yellow line shows you institutional positioning week over week. Yellow line has been trending lower, right? So institutions have been selling the dollar. You know what else they've been selling? I find this to be really interesting. S&P. Kind of a net selling here in recent times in the S&P 500 from the Commitment of Traders report showing institutional flows. Gold's been kind of trickling higher. So to me, this is something to keep an eye on. And by the way, if you don't have the Edge Finder, we did just drop a free demo version where you can play around with some of our tools here on our website. Boom, there it is. Click that link. If you want to try out the Edge Finder, if you want to check it out, we dropped a free version on our website. For now, there is no plans to discontinue the free version. It may change in the future. We used to have a free version. We took it down, but for now, we've brought it back. I think it's better than ever. And you'll get a chance to explore some of the features of the tool. And if you like it, you may consider purchasing the full version at a later point. So check it out, click that link, fill out that form, and it will direct you to where you can explore the free limited version of the Edge Finder to see all of the different features that it offers. So to me, that kind of, you know, I'm actually kind of in agreement here. I think the idea of moving away from stocks, raising cash to have on the sidelines, being long gold and silver, these things I largely agree with. And that seems to be the trend of institutions right now. You've got silver looks a little bit mixed, but gold, again, some accumulation here from institutions. Dollar, they're selling. Euro, they're buying, which I think is really interesting. So like long euro, short dollar looks attractive to me. You've got Japanese yen. They've actually been selling that one. So I don't have a big interest in trading the yen at this time. Let's see, what else do we have? US dollar, I mentioned this earlier. A little bit of net selling going on in the US dollar here recently. So definitely interesting. How about platinum? I could look through 1,000 of these. If you want to explore it further, check it out on the Edge Finder. NASDAQ's down 1% here today. So again, seems like the market in response to meeting minutes didn't move too much, maybe just a little bit of dovishness there. Look at US oil here. Someone just asked for oil in the chat. I'm interested in oil only if this, like most markets, is just dead movement wise. It's not moving very much. If you give me a big pop on oil to the upside in the next few days, I'd potentially look to short that. So we'll see. But yeah. Also, for those of you guys who do try out the Edge Finder and you start using our website, we've put together a ton of free resources on our website, a1trading.com. We'll have our planned dates for everything for the stream. You can always look up A1 live stream right here. Just go to a1trading.com, I highly recommend you bookmark our site because we've got a bunch of free tools for you. We've got free courses on risk management, technical analysis, fundamental analysis, our Get Funded course we just dropped, our options trading course. All this stuff is free. Just head over to a1trading.com, and you can also keep up to date with the live stream schedule that we're putting up on our website. We keep this up to date so that you can see what our game plan for major events is looking like. So Jackson Hole Symposium, we are going to figure out what our timeline is, but we will be streaming that event because that is a really important event this week. It takes place on Friday. Like I said, try out the Edgefinder free demo. We'll drop that link one more time here before we end the stream. We're going to cut it there. Thank you guys for tuning in. And remember, try out the Edgefinder. Our Edgefinder free version just dropped. Link is in the chat. Thank you guys very much for tuning in. Have a great rest of your day.
Thanks for watching today's show. Remember to subscribe if you're new and to turn on post notifications so you don't miss the next one. If you're looking for more free trading content, consider joining our Telegram channel, linked in the description down below, or find free courses, prop firm discounts, and broker sign-up perks on our website a1trading.com. That's all for today. We'll see you back tomorrow.